Okay, everybody, thank you for joining. This is going to be part 2 of our multi-part webcast in modeling, and this whole multi-part webcast is a little bit of a different perspective than what we did and how we did it last year, just based on your feedback. This is going to mimic basically what you'd get in a mini crash course, a multi-day crash course that you'd come in and take all day. We're breaking that up into several hour sessions. And so the perspective is really all about, if you were given a model, how do you link it up? We won't do the, in our school, we'll do a whole semester long, 300 hours of a really deep dive using cases. We can get there, assuming that there's enough people interested, but in the beginning, our first cut is, how do you link up a model together? And then again, if there's interest, we're going to do a deeper dive and talk a little bit more about the concepts and talk a little bit more about, if we were to take a real company, how do you deal with nuanced line items? How would you think about making projections? So what I had done was, there's a handout here. If you guys have access to the handout, you can see downloaded is the file that we had ended up with, which is the one that you're looking at now. I had also sent a link during the week of the actual template, which is starting from scratch. So if you want to just kind of pick up from here, you can just download that file. And if you want to go back, you can always, I've emailed around, and it's up on YouTube, the very, very first session. So what I want to do now is kind of recap where we went and talk a little bit about where we're going to go today. So last week we focused on building a model from scratch, starting with revenue all the way down to net income. And as you know, we had talked about revenue being driven as a product of pricing and volume. So in this example, we assume that their pricing, $20 per unit, would stay flat, but the company's volume and units would grow at 10% a year, meaning their ultimate revenue would grow at 10% a year, and their costs are projected at some percentage of that revenue, the percentage we've identified by looking at the historical values. We built down to net income and noticed that we had left depreciation and amortization empty, and we had left interest expense and interest income empty. When building a full-scale model, that's what you would do, because the depreciation and amortization and the interest expense and interest income will come from respective supporting schedules. The depreciation will come from the depreciation schedule. We'll probably look at that today. And the interest expense and interest income will come from the debt schedule. That's pretty much the last schedule that we'll build. We then built down to net income and calculated earnings per share. So today what I want to do is I want to look at the cash flow statement. I want to talk about projecting the cash flow statement. It's actually pretty simple from a template standpoint. It can get more complicated when you're looking at a lot of nuanced line items. I'll mention that briefly, but again, if we get to the level where we're taking a deeper dive, I'll talk about that in more detail. And then, assuming we're going to have time, we're going to start looking at some supporting schedules that help support the continuity of the income statement and the cash flow statement, namely depreciation and working capital. So the first thing I want you to know, and again, I'm not going to focus on the concepts here, but just briefly to mention that the cash flow statement is broken up into 3 major segments. The cash from your operating activities, cash generated or spent from investing activities, and cash generated or spent from financing activities. And the total change in cash at the end of the schedule is a sum of these 3 segments. So I first want to historically look at, and again, we're assuming here that these numbers have been already hard-coded in, let's say from an annual report. And what I do want to do is total up these sections. It'll also help you give a great illustration as to how these sections come together. So in the cash from operating activities, we will make the projections, but first from a historical perspective, the cash from operating activities comes in several major components. 1, net income. Cash from operating activities starts with net income. Your cash flow statement starts with net income. That is a starting point from this method of cash. Next, amortization, and I'll lump this in with any other non-cash items. So again, this is a template, but in a real company, you might see 5, 6, 7, or 8 other line items that are a little bit separate from the standard pieces and components that I'm going to give you now. And so projecting those typically takes a little bit of time and a little bit of research, and if anyone has my book, Financial Modeling Evaluation, where we build a full-scale model on Walmart, which I recommend looking at as a deeper dive after this series, we talk about smart ways, actually 7 specific methods, in how to make those projections of other unknown line items. But from a standard perspective and what you'd read about from a basic perspective, cash from operations starts with net income and includes depreciation and amortization, other non-cash items, deferred income taxes, and changes in working capital. And usually if you read about this in a textbook, they'll just note changes in working capital as the one total line item. We've broken this out into several components, which we will model out from its respective schedule, the working capital schedule. So to recap, if somebody says, what is the components of your cash from operating activities? It's net income, depreciation, amortization, other non-cash items, deferred taxes, and changes in working capital. It's those 5 segments. The total cash from operating activities is a sum of everything. So what I want to do is I want to first, from an historical perspective, total up the changes in working capital, which is a sum of these working capital items that make up the changes in working capital section. So if you remember from last class, we did a big alt equals. Alt equals is a quick way to sum everything in a column or a row. Another way of doing that is just do equals, SUM, open parentheses. You can use the mouse to highlight all these line items, close parentheses, hit enter. That's the total of the working capital section. And I can copy this to the right. If you remember, you can click and drag, simple way, or you can use the keyboard, holding down the shift key, tapping the right arrow 2 times, letting go, Control R. Control R stands for copy right. And then the total of the whole section is equals the segments that I had mentioned before, and you know what I did? Okay, yep. So net income is empty. We're going to pull this in from the income statement. So just bear with me, even though it's not linked up yet. Net income, these 5 items that I mentioned for net income, plus depreciation, plus non-cash items, plus deferred taxes, plus changes in working capital. It's the 5 segments that I mentioned before. These are the segments that you add up that make up the total cash from operating activities. You can hit enter. You can copy to the right. Okay? We then have total cash from investing activities, which, again, we're not going to focus too much on the concepts, but CapEx is the major component. It is the purchase of property, plant, and equipment. And the total is going to be a sum of everything from above. Alt equals. These other line items are just other types of investing activities. Investing in property, selling property, investing in equipment, selling equipment, investing in securities, selling securities. Alt equals. Then we have the financing activities. Again, we want to total up the financing activities. The financing activities I like to think of in 3 major components: debts, equity, distributions. Debts meaning borrowing debts, paying back debts. Equity meaning raising equity, paying back equity. And distributions, paying out equity holders. Common dividends, non-controlling interest. Add them up, alt equals. And so what that means is the total change in cash is a sum of the 3 major segments. So we're going to have plus cash from operating, plus cash from investing, plus cash from financing. That is the total change in cash and cash equivalents. The supplemental data, this is for the debt schedule. We're going to deal with this when we deal with the debt schedule. This is what you should have. Okay, so that's a quick overview of what the historicals are made up of. Notice I didn't hard code in net income because net income also comes from the net income that we just created from the income statement. And so when you look at net income, when you look at the income statement, we want to pull net income in to the cash flow statement. Now notice there are several net incomes. Net income from continuing operations. Net income after our non-recurring events. Net income after dividends and minority interests. Each one just is a little bit further down the income statement, has all the above line items removed from it. In other words, net income from continuing operations is the income before tax minus tax expense. The net income after non-recurring events is equal to the net income from above minus non-recurring events. Net income after dividends is the net income from above that minus the dividends and the non-controlling interest. So the net income that we typically take to drive the cash flow statement is the net income before payouts to equity holders. And there's a good reason for that. Why? Because we want to include, we don't want net income after payouts, because these payouts, these dividends, these non-controlling interests will be removed in the financing activities, dividends and non-controlling interests, in the financing activities of the cash flow statement. So if we were to take out, knowing that, if we were to take out net income after minority interest, if we were going to use that at the top of the cash flow statement, and if we were going to do that and remove dividends again, we'd be double counting. We'd be taking out dividends twice. We'd be using net income after dividends have already been taken out, and then subtracting dividends again, double counting. So for that reason, because the dividends and the non-controlling interests are removed in the financing activities, we want to take the net income before they've been removed to avoid double counting. So let's pull in the net income from before dividends. We're going to do that by taking, in D6, clicking equals. Then we can click over to the income statement, and we want to select the 2009 net income before non-controlling interests, before common stock. Okay. And then we can hit enter. And then we can copy this to the right. And I want to copy this all the way to the right, because now we're going to talk about our projections. Okay. And it's the same type of net income that we're going to use for our projections. Just click it, move it all the way to the right. If you notice, the total gets now populated because you should have included that cell, even though that cell wasn't populated yet, into your overall total. Next, depreciation. Now I said depreciation is going to come from the respective schedule, the depreciation schedule. And we'll probably get time to talk about it today, I think. If not, we'll do it next week. But the way I typically like to see the flow is the depreciation is going to come in to the income statement and then flow from the income into the cash flow. So what I'm going to do is I'm going to pull depreciation from the income statement into the cash flow statement, even though it's not linked in yet, knowing that once we get depreciation populated, that will flow into the income statement and then into the depreciation schedule in the cash flow statement. Now, some people like to say, well, why do that? I can just pull this directly from the depreciation schedule. I guess you can do that. I just like, when we start to talk about the concepts, when I do it at the school, and if we get to that deeper dive, conceptually it makes more sense to me, because what the cash flow statement is doing is basically negating the depreciation line item directly from the cash flow statement, or the income statement. So to me, it makes a little bit more logical sense. So I'm going to have this equal to the income statement, depreciation, amortization. It's going to be 0. Copy to the right. It's going to be 0 because it hasn't been populated yet. Once we populate it into the income statement from the depreciation schedule, it'll populate this. Amortization of identifiable intangible assets. This line item is actually specific. This is in our other line item section, so I'm going to keep this 0. But this specific, the name of this line item, this is to deal with M&A. We talk about this when we talk about M&A. For now, let's keep it 0. I'm going to hard code this 0. I'm actually just going to copy this all the way to the right. It's been 0 in the past. It's going to be 0 going forward. Okay? If you see anything 0, just keep it at 0. And it's blue because it's a hard-coded number. Remember I mentioned anything hard-coded or assumption drivers should be in blue font. Deferred income taxes, we will do this in the depreciation schedule. I'm going to highlight this yellow because I need to remember I'm going to have to link this in from the depreciation schedule. There's a deferred income tax line item. Same thing with working capital. Working capital will come from the working capital schedule. We're going to build the working capital schedule independently and then later link in the changes into here. Okay? So that's it. And that's one thing I do want to point out. A lot of the cash flow statement line items in the operating activities do come from supporting schedules. And that's why after we're done with the cash flow statement, or after we've gone as far as we go, I'm going to suggest to now start building the supporting schedules to populate this. Okay, I want to pull the totals over. We've calculated the totals. Let's copy them over all the way through, even though we don't have all the information populated yet. Now, once we populate this information, it'll link through. Okay. CapEx. CapEx will also come from the depreciation schedule. We're going to project this in the depreciation schedule here. Okay. And actually, I'm just noticing now I have different versions of the model. It's already been projected for you. So if it hadn't, we could project it here. But okay, since it's already been projected for us, let's pull it in. So just kind of note, CapEx is here supplied on the depreciation schedule, so we want to link this in. So we're going to link this in from the depreciation schedule. And here, notice CapEx is shown as a negative because it represents a cash outflow. Okay, so you always want to make sure CapEx is shown as a negative. So I'm going to hit minus, and then I'm going to go to the depreciation schedule and click the 2012 CapEx, negative 1,000. And I copy this to the right. So we've pulled that in. Okay. These other line items, I remember mentioning to you before, the difference between a template and a case is there's going to be a lot of nuanced line items. You're going to have to think about how to project them. I want to focus again here. This is like a crash course. I want to focus on the template. How do you link up a model? If you've seen 0 before, let's hard code these at 0 for now. And I want to move the total over. Okay, the most important piece here is the CapEx. Okay. Now we have debts. Anything related to debts in the financing activities, and here we have short-term debt and long-term debt, come from the debt schedule. We're going to pull these in from the debt schedule. The issuing of stock, issuing of common stock, issuing of preferred stock, buying back of stock, this information are projections. We'll keep them at 0. The dividends and the non-controlling interests, we modeled out last week. They come from the income statement. If you notice, if you recall, in the income statement, we have dividends of 80. Again, like CapEx, this is a payout. So because it's a payout, we want to pull it in as a negative. I'm going to hit negative. We go to the income statement, negative 80, copy to the right. Same thing with non-controlling interest. Even though it's 0, I want to illustrate the fact that this is coming from the income statement. So I'm going to hit minus, go to the income statement, pull in that 0, copy to the right. Other was 0, keep at 0, copy the totals to the right, and that's it. So a couple points here, a couple points to make. You know, the cash flow statement, projecting it, isn't that difficult from a high level. You know, sticking with the template and avoiding dealing with the confusing nuances of all the one-off line items are supposed to make it clear how an income statement links to the cash flow statement, links to the balance sheet, which is important for interview preparation and as a first cut. In Walmart, for example, if you want to look at the book, if you're curious in getting more detail, you'll see the myriad of line items that complicate a cash flow statement. But it's important to note that those are one-off and not directly pertinent to the flows between the income statement and the cash sheet and the balance sheet. Here, this highlights effectively, literally how an income statement drives the cash flow statement, which is net income and depreciation, and what other sections are needed to support the rest of the cash flow statement. Depreciation schedule, working capital schedule, debt schedule. So the point of, again, these crash courses and these templates is to make that completely clear before digging deeper. I don't see questions. I hope people can hear me. Let me know if you have questions. This is a good time for questions. If not, we're going to talk about the next step. Okay? Okay. All right. Next, I want to, so the perspective is this now. The next major schedule to build is the balance sheet. However, there is so many things missing with the cash flow statement. And knowing, which we'll discuss, that we're going to use the cash flow statement to build the balance sheet, we need to really get the cash flow statement a little bit more complete before we can accurately build the balance sheet. So although we look to the balance sheet as the next major schedule to build, we know that we need to start building out these small ancillary schedules before getting there. So the first major one is the depreciation schedule. Then we'll build the working capital schedule. Once we have depreciation and working capital, we'll have a lot more complete. We'll have enough to use the cash flow statement to drive the balance sheet. We'll then build the balance sheet with the cash flow statement. Then we'll have almost everything done except for the debt schedule. We'll build the debt schedule, and then we'll be done. So I want to look at the depreciation schedule. And notice, let me show you the form right here. Notice we have our starting points. Our starting point of the depreciation schedule is the PP&E and the CapEx. Again, this isn't supposed to be a conceptual class, but depreciation is accounting for the aging of assets. And in the model, there are two series of flows that we depreciate. There's the property, plant, and equipment. This is the property that the company has had over time. And there's capital expenditures. Capital expenditures is the investment into property in the future. This is the property that will be created in the future, and if it's property in the future, there's going to be depreciation on that property in the future. There's also a couple ways to depreciate. There's the more common straight line method, and there's also the accelerated method. There's a benefit of one versus the other. Again, mechanically, I want to just talk about the straight line method, and then we'll talk about the accelerated method next. Notice one thing, though. Before building and constructing these supporting schedules being depreciation and working capital, depreciation starts with our balance of property, plant, and equipment. Operating working capital starts with current assets and current liabilities. These are balance sheet line items. Current assets, current liabilities, PP&E, these are balance sheet line items. So although I mentioned not building the balance sheet projections yet, we do want to look to the balance sheet, at least the last reported balances, to be able to find what values can begin our depreciation and working capital schedules respectively. So for example, we still need to look, we can't build it yet, but we still need to look to the last reported net PP&E balance to start our depreciation schedule. So we did that. So if you had an annual report, you just go total assets, total PP&E. And in here, in this case, that total PP&E, there it is, PP&E net is 5275. That we will use to start our straight line depreciation. And this is how depreciation works. Okay? We have a table underneath. Each line is going to be depreciating the respective PP&E and CapEx in each specific year. It's a little difficult to explain, but let me just start by showing you how PP&E works. Okay, so PP&E is 5275. Straight line depreciation means if it has a useful life of 10 years, that 5275 will be depreciated evenly over 10 years. If it's depreciated over 10 years, that means the annual depreciation is the 5275 divided by 10. So I'm going to take in cell G10, 5275 divided by 10. Now, that means the depreciation is going to be 527.5 each year for 10 years. By year 10, it'll be worth 0. So I basically want to copy this to the right. But notice, when I copy this to the right, my value is 0. I don't want my value to be 0. I want it to be 527.5. Why is it 0? Because remember, as you know from last week and probably from using Excel before, when you copy to the right, the references shift along with what you're copying to the right. I want to copy this to the right, but I don't want my references to shift. So to copy things to the right and to lock the references and not have them shift, you put $ signs in front of each cell that you're referencing. So if I do $G, meaning lock the column. If I copy to the right, then the references shouldn't shift. And that's right. Look what happens. When I click now this, it would have originally referenced the cells above it. It didn't. It locked into place. Anchoring references is a handy tool. So what I'm trying to illustrate here is the fact that that net PP&E is going to give me total depreciation of 527.5 each year. Okay, and to better illustrate what's to come, what I want to do now, what I want to ask you to do now is let's total up these columns. I want to show you how it's going to change as we populate it. So right now, in cell G18, I'm going to do equals, sum, open parentheses. I'm going to highlight the whole column. Do not include the years. I'm going to hit enter, copy everything to the right. So this is the total that I'm going to link through. So right now, based on my PP&E, I have 527.5 in depreciation expense. Now, there's going to be more depreciation expense. Why is there going to be more depreciation expense? Because I'm building more property. That's what CapEx says. CapEx says I'm building another 1,000 in property. Well, once that property is built, I'm going to have more depreciation expense. How much more? Well, we're going to assume that that property has 10 years of existing useful life. So, in this column that reflects 2012 CapEx, meaning what's the depreciation on the 2012 CapEx, I'm going to take that 1,000 and I'm going to divide it by 10. But I'm going to anchor the cells. Quick way to anchor cells, F4. F4, while you're still editing the cell, add the dollar signs automatically. So I'm going to do equals. I'm going to key up to that 1,000, F4, anchor it, divided by the 10, F4, anchor that, hit enter. Copy to the right. Now look what's happened. I got the 5,275, depreciation on the PP&E. I got the additional 100, depreciation on CapEx. So I have a total of 627.5 in depreciation. Okay? Now, where this becomes tricky, what happens in 2013? Well, in 2013, I'm building more property. I'm building 500 more. That property is going to depreciate on, let's assume, 10 years. These years underneath reflect the straight line depreciation on the property from above. Okay? So what's going to happen in 2013? Well, I'm going to assume that at 10 years, the depreciation on that property is going to now be 50. However, notice we have a row reserved for 2013 CapEx, it's this empty row. That depreciation won't begin until 2013. So for that reason, we're not going to put anything in this cell. Because if I put something in this cell, it'll total down to 2012. And the point is, that property wouldn't have been built until 2013. I want it to total here. So in 2013, in H12, I'm going to have equals this 500, anchor it, divided by this 10, anchor that, and hit enter. And copy to the right. So the perspective is here is, by 2013, I have now 3 pieces of property that's going to depreciate. I got the PP&E that was existing from before. I have the CapEx that I built in 2012, and I have the new CapEx that I built in 2013. Each depreciates respectively. And so on. 2014, let's say I built something else. And in 2014, that 750 property will depreciate at 10. I'm going to equal 750, anchor that, divided by 10, anchor that. So in 2014, I now have 4 pieces of property. I have the original 5,275 depreciation on the original PP&E. I have the 100 depreciation on the 2012 CapEx, 50 depreciation in 2013, 75 depreciation in 2014, and so on. And that's why they call this a waterfall schedule. It trickles down. I'm going to go ahead and build this out very quickly. Okay, and what I'm going to do is now I'm going to pause this. I'm going to give you 4 or 5 minutes to try to catch up. I'm going to stop the recording because I know that this is where we lose a lot of people. Rest assured, we do have this record it so you can play around with it, but this is what you should have. So again, I want you guys to practice this. Whoops. Let me give it a quick 5 minutes. I didn't do this last time, but I'm going to give some stopping points so you guys can ask questions and see if you want to catch up, because I know this might take a while, especially if it's your first time, and then we'll come back in 5 minutes. All right, so this is what I want to do next. I want to focus on accelerated depreciation. Now, accelerated depreciation, actually, let me link this up. Once you have depreciation, and if you didn't get there yet, that's fine. You can still do these links. This links into the income statement and then flows into the cash flow statement. So the income statement where indicated, where we left it out last week, I'm going to link in. I'm going to hit equals, depreciation, the book depreciation, hit enter, copy to the right. I'm going to take out the highlights. And that should flow into the cash flow statement already. Okay. And now we're going to go back to accelerated depreciation. So the idea of accelerating depreciation, as opposed to straight line, is setting up your depreciation schedule such that instead of having the depreciation even each year, the depreciation will be greater in the early years and lesser in the outer years. There's a couple of benefits of doing that, or there's a couple of reasons why someone would want to do that. One is a company might actually believe that their assets don't depreciate evenly. A company might believe that their assets depreciate faster in the early years. One good example of that are automobiles. People might believe automobiles depreciate faster in the first few years. Another reason for doing that is if you have greater expense earlier, yes, that means less net income, but the way the cash flow works, because depreciation is an add back, it does mean you'll have a greater add back to your cash flow. So we'll talk about the idea of accelerating depreciation and actually creating a positive cash add back in a deferred tax liability. So we might get to deferred tax liabilities today, we might not. What I do want to focus on are methods of accelerating depreciation. There are several, you can find them in our book. There is declining balance, double declining balance, units of production, some of the year's digits. The one that's done in the U.S. is a modified accelerated cost recovery system, MACRS. Makers is the only way you're allowed to accelerate depreciation in the U.S. And the way Makers works is there's a series of percentages that are given. There's a table, you can look it up on irs.gov. You can look up Makers schedules. If you have an asset whose useful life is 10 years, you'd look up the Makers percentages for a 10-year asset. And they give you percentages that look like, these aren't the exact percentages. I rounded them just to make this modeling easier. But it would be a set of percentages much like this that's higher in the early years, and that would decline in the later years. And when you look up those percentages, you would apply them to the balance of the property, and let's do that now together. So for example, let's say I went to irs.gov and I said, what are the percentages of declining balance for a 10-year useful life? And let's say they would have given me 25, 15, 10, 10, 10, 5, 5. This is what you would do. You would apply for depreciation on property, plant, and equipment, you would apply 25% of the 5275 is the year 1 depreciation. 15% is year 2, 10 year 3, 10, 10, so on. So as these percentages decline, your depreciation expense is going to decline. It had been accelerated and it's declining. So what does that mean? Well, if you look under here, here's the accelerated depreciation box. This section is just for putting in the percentages. This is where we're going to apply the percentages for our depreciation. So in the first year, I'm going to have 25% times the property. In the next year, I'm going to have 15% times the property. In the next year, 10% times the property. okay? And so on. It declines, okay? Notice one thing. I'd like the opportunity or the option to copy this to the right, but I can't. Why? If I copied this to the right, I'm going to get a lot of zeros. Again, because the references shift. In this case, I would like the reference to the percentage to shift. I would not like the reference to the PP&E to shift. So I want to anchor just half of the formula. I want to anchor the reference to row 6. So in other words, in the first cell, I can go in and just anchor G6. I can click G6 and hit F4. I can put a dollar sign in front of the G and G6, hit enter. If I just anchor the portion that I don't want shifting, look what happens when I copy to the right. The anchor to the numerator shifts, to the top portion, and the anchor to the percentage, the anchor to the percentage shifts, the reference to the percentage shifts, the reference to the actual property does not shift, it's anchored. And that's what we want. Okay? I'm going to continue. With 2012 CapEx, I'm going to do pretty much the same thing. I'm going to take the 1,000 and I'm going to multiply it by the 25%. But I'm going to reference the 25% in the 2012 CapEx column. Although a little redundant here, that might change if this CapEx had a different useful life. You'll have a different set of percentages. So it's important to have it laid out at least. Okay? And because I want the reference to that 1,000 anchored, so when I copy to the right, I want 1,000 times 15%, 1,000 times 10%, and so on. I'm going to put a dollar sign around the G. Copy to the right. Listen, I'm aware this depreciation is a lot. So once we're done with the depreciation, I'm going to stop. I want you guys to take a week to practice this. So by next week, we'll be ready for working capital. It's a lot. I'm going to continue. 2013 CapEx, we won't have anything here because that property hadn't been built until 2013, until here. So I'm going to take 2013 property and multiply by this 25%. Now, don't make the mistake that a lot of people do where they say, okay, we're in second year, it's 15%. No, every new property starts from scratch. Accelerated depreciation means every new property starts with 25%. If you were to start with 15%, then you're not accelerating as much. Every new property starts with 25%. I want to anchor the reference to 500. Copy to the right. Okay? I'm going to go a little faster, and I'm going to give you time to catch up. The next year, same thing. I'm going to reference CapEx from the year above, and I want to start that at 25% above. Don't make the mistake of going down to 10%. You're no longer accelerating. Always want to start new property with 25%. I'm going to anchor the reference, multiply by 25%, copy to the right. I'm going to pause here because I know from experience this is where you guys need some catching up. Let me pause. And again, for you guys that are watching the recording, I'm going to just stop recording. So you might see me jumping in. Just pause your recording. So if you're still working on this, I'm going to kind of just quickly show you how to go through this. And of course, you can watch the recording and kind of see it in slow motion. For the next year, it's 1,000. We're going to anchor the reference to the 1,000. Oops. And we're going to multiply it by the 25% in that particular year, and so on. For 2016, it's the CapEx from the year above. Anchor that. 25%. Copy to the right. Next year, 750. F4. Anchor that. 25%, copy right, and then finally, 1,000, anchor that, 25%. And we could do an alt equals to add everything up. Now, deferred taxes. Again, I don't want to focus and dwell too much on the concepts, but this is a confusing one, and maybe if I don't have the slides with me, but I'll think about it, seeing what We can maybe open up next week with the slide just to illustrate it a bit more as we go into working capital. Deferred taxes is based on timing differences between reporting for GAAP and reporting for tax purposes. As many of you guys know, companies, when they report two sets of books. They report GAAP financials, but then to the government, for tax purposes, they report a different set of financials. Those set of financials could have different accounting rules. Or in other words, they can apply and file tax financials using slightly different accounting rules than GAAP. So sometimes there's an advantage in using different accounting rules and causing timing differences. For example, you can report a set of annual reports for GAAP purposes that has straight line depreciation. Okay? Yet for tax purposes, show an income statement with accelerated depreciation, higher expense. Why would I do that? Well, for GAAP, straight line, lower expense. Lower expense means higher net income. Means what? I can report higher EPS for my shareholders. But for tax purposes, I can show pretty much the same income statement, but show a higher depreciation expense and say there, I accelerated my depreciation for tax purposes. What benefit does that bring? Higher expense. Yeah, lower net income, but that means you're paying lower taxes. So in other words, you have a set of reports. You're showing publicly lower expense, higher net income. Yet for the government, you're saying, okay, well, I'm increasing my expense. I'm getting more deductions. I'm going to pay less taxes than what I reported on GAAP. You're not hiding anything, or you're showing them. You're saying, I reported X amount for GAAP purposes, but for tax purposes, I'm showing a little bit less, which doesn't mean you're avoiding paying taxes, but you're deferring them in the short term. It is a way to avoid paying taxes in the short term, and then you have to ultimately pay them later. This creates a deferred tax liability. And I have a great slide that shows much better side by side. I honestly didn't think we'd get this far this fast. I guess because we're doing it, I'm used to doing this when going through all the concepts and going through the hard codes. We're doing this a little bit more of an accelerated perspective this year. But the way to back into what that tax savings is effectively is it's the difference in expenses times tax rate. Why? Because, well, basically you're expensing this in one report, but you're expensing this in the other report. So the difference is the difference between the taxes, but times the tax rate. Times the tax rate because you want to show the tax impact of it. So I'm just going to do the mechanics here. And the mechanics here is the way to calculate the deferred taxes is by subtracting the depreciations. So I'm going to take the accelerated depreciation minus the straight line. Okay, copy to the right. And I'm going to multiply by the tax rate. That gives me the deferred tax liability. The tax rate we have to pull from the income statement, making sure you're pulling in the right taxes that were actually the right percentage from the respective year. So I'm going to pull in, I'm going to go equals, income statement, 35%, copy to the right, and I'm going to multiply the difference in depreciation, the difference in expenses, times the rate, is the exact amount of the taxes that I had expensed on GAAP but did not pay. That's the deferred taxes. Those are the taxes that I deferred. So when we look at the income statement, it's important to notice this is GAAP. This is the straight line depreciation, not accelerated because it's GAAP. When I look at the cash flow statement, this is GAAP. This is not accelerated depreciation. The only thing that accelerated depreciation does here is it shows us and it helps us to create our deferred tax liability. That's its purpose. This value, this total accelerated depreciation value, does not link anywhere up, but it helps us create deferred taxes. That links somewhere. That links into our cash flow statement. So I'm going to pull that in from the depreciation schedule, deferred taxes, link that to the right. Okay? and this is where I'm going to stop. It's 11 o'clock. I've been limiting these to an hour. Based on your feedback from last year, it's a lot more sense. A lot of people tell me the drawback to these crash courses is 5 hours in a day. It's so much information. I'm going to do this in 1 hour increments. You let me know if that's a good approach. Okay, I got to save this as a different name, of course. I'm going to save this as November 6th. And like I had mentioned last time, it's going to take me a while to convert this recording, but I want you to have it. I want you to work on this during the week. If you feel like you want a lot more detail now, I recommend to buy the book. Next week, we're going to get into working capital. We're going to link working capital through. If we have time, we're going to start talking about linking cash flow into the balance sheet. Week after, we'll build the balance sheet, and by the next week, we'll almost be done. And then I want to get your feedback. I want to see if it's worth for you guys taking a deeper dive. So if you have any questions, let me know. Appreciate your feedback. I'm going to set up a time next week to go through the next step. We'll take it from there. Thank you for joining.